My guest today is Jason Andrew, the co-founder of a holding company, Arbor Permanent Owners, a team of operators and investors committed to growing businesses for the long term. And they're doing that in Australia. And they just closed their fundraise and the cornerstone deal, 40-year-old manufacturing business in the materials handling sector, 25 million in revenue, 25% plus EBITDA, and they paid around 4 times. Thanks a lot for coming to the Holdco Builders podcast, Jason.
It's an absolute pleasure to be here. Thanks for having me, Mick.
Before getting into how you did it all and how you met Simon and Rowan, your co-founders, please share your story and life before it all happened. What were you doing before?
Yeah, absolutely. I'll share my professional life because beyond that's a bit long. But so I'm a chartered accountant by background, which if you're listening for the US or parts of Europe, it's basically the equivalent of a CPA in the USA. So my professional background is basically cutting my teeth in accounting and taxation for small businesses. And then I worked for a long stint in corporate finance, doing valuations, buy-side due diligence, M&A, and stuff like that. So that's kind of where my technical chops have come from. And whilst I don't consider myself an entrepreneur, I've been kind of interested in business and investing from fairly early age. I came across Warren Buffett in my youth, and one of the things he said was that accounting is the language of business. And I wanted to learn business, so I pursued a career in accounting, which is how I ended up in that path. After working as an accountant for over 10 years, I started my own practice. That company's called SBO Financial, and that was with my business partner, Rowan, who's also an accountant. And we started that business 10 years ago when basically there was a big shift from desktop accounting software into cloud accounting. So QuickBooks Online or Xero or XERO, that was kind of like the SaaSification of accounting. And we really kind of rode that trajectory, right place, right time, this type of business around providing kind of outsourced finance function services to growing businesses. And we were probably one of the first in Australia to do like a fully remote work environment. We leveraged teams in the offshore, in India and the Philippines. And so we're probably one of the early movers in that. Today, that business still exists, multiple 7 figures of recurring revenue. We employ over 30 plus accountants. It's profitable and it pays a good dividend every year, which is basically funds my personal life. Accounting firms as a business, they're really good. They have the attributes of a good cash flow business. There's recurring revenue, they're capital light, there's no inventory, the debtors are pretty low, and they're good margins. You can get 25 to 30% EBITDA margins out of accounting firm practice pretty simply. You don't have to shoot the lights out, like that's a good business. But like most services businesses, they are actually very difficult to scale. Fundamentally, services businesses are labor-based businesses. They have very limited operational leverage. Probably a few years into the journey, we had some grand ambitions to scale the accounting firm into like a really, really big enterprise, $100 million of turnover. But then we realized how difficult that is actually to do organically. And I remember reading I think it's like the diary of Naval Ravikant's Almanac or one of the books, and he talks about how to create wealth. He talks about leverage to create wealth, and he basically talks about there's 3 ways to create leverage in business to create wealth for yourself. There's labor, and then you can leverage labor, you can leverage capital, which is like funds management, or you can leverage product, which is like software, e-commerce, and things like that. And so if accounting firms are fundamentally, they're a labor leverage business model. It's the oldest form of leverage. Ancient Egyptians leveraged services and slaves to build the pyramids. Today, law firms leverage associates and legal practitioners to deliver legal services, and I guess accounting is no different. Yes, you can value-based bill, you can use technology to streamline operations, but fundamentally it's a services business, right? You need people to deliver the service to your customers. As you grow more customers, you need more headcount, right? There's very limited operational leverage. And in fact, I think it's the opposite. As you get bigger, you have layers of management which are non-revenue generating, which impacts margins. And so services businesses are great cash flow businesses, but not great to create equity value. So we recognize the desire to if we want to build real wealth, true wealth, we need to be taking profits or cash flow and investing that into businesses that actually have leverage, leverage products or funds basically. So we kind of restructured our business from SBO just being the accounting firm into a subsidiary of a holding company called the Arbor Group, which is kind of, a joke, is Australia's smallest family office, which is basically myself and Rowan as the owners. And basically the philosophy behind the Arbor Group is to compound capital at high rates of return in private markets. So our philosophy is that patient capital invested into private companies will deliver superior returns over the long term. That's our philosophy. And so all the investing we do within the group is in private markets. We set up a VC fund about 8 years ago where we raised some money off very small funds, but raised some money off some co-investors. That's 8 years of its 10-year life. So it was a traditional 2 and 20. And we've been investing business off our own balance sheet from the profits of the accounting firm. And then it kind of led us to our recent venture, Arbor Permanent Owners, which is, basically a boring business holdco is the way to describe it. And how we landed into that was part of my accounting work is that we did a lot of the buy-side due diligence for search funds and micro-private equity firms. And, 3 years ago, I had no idea what a search fund was. I didn't know what the model was, but I met a few folks, earlier adopters of Australia doing this model. And I really fell in love with the silver tsunami thesis of, buying great enduring businesses from retiring owners. And so for the last several years, I've followed all the holdco guys abroad, particularly in America. A lot of it through your content, by the way, which is absolutely exceptional. So you're doing a great job. But people like Andrew Wilkinson at Tiny, Brent Bishaw, Chen Marks, Xavier at Enduring Ventures, also following a lot of the Scandinavian serial acquirers around the world, Lifco, Roco, obviously, Canadians Constellation Software. So I really admire of the serial acquirer model, but like paired with this kind of silver tsunami thesis. And what we realized that actually no one was doing this in Australia. Sure, family offices and kind of large companies buy other businesses and smaller businesses, but there was no one really doing it in a repeatable strategy. And so we thought, actually, we think we have probably the capability and the long-term vision to maybe have a crack at it. And that's when we met Simon, our third business partner in Arbor Permanent Owners. And actually how I met Simon was through a cold email back in 2021. And we've been good friends ever since.
Yeah, so you have so much... what I mean is you've learned so much probably by just building other businesses before you decided to jump into this. And plus, you have this cash cow, which helps you to do all that, because searching for a deal, searching for a maybe third co-founder, it takes time. And but there is no stress from your end. And this probably helps to put you in a situation that you're not in rush, and you're not in rush and doing maybe a bad deal, But
I think that's probably the criticism I do have with search funds. Like, I love the search fund model. I think that ETA is a wonderful space, but my only thing I disagree with the search fund model and how the traditional search fund model is structured. I know there's variations or permutations of it, but the idea that you give a searcher, $500,000 or whatever the fund is to go and find a business within a 2-year period, that's a fuse. You've set a burn rate. And if they don't find a business, they're dead, they're underwater, right? And if you look at any investor, like you shouldn't be trying to find a business because it suits your time frame. Like, you should be waiting for the best business that comes to market or searching for it. And I think you've got a time pressure to deploy capital, which is pretty typical in most PE and VC funds as well. Like, they have the same pressure. It sometimes doesn't allow you to make the best investment decisions because, your incentive is to just find a business as opposed to find the best business or the best investable business. And so I think, you're right. I think we did have the patience to, take things a bit slowly and things, but at the same time, that time has an opportunity cost. Like, I still want to be doing things, I still want to be active, and spending 2 years searching for a business is not my idea of being productive. Despite that being, towards a goal, it's like you still have to time block goals. Otherwise, you can spend 5 years searching for a business and not actually taking the action.
What about your teamwork with Rowan? Was he happy doing this, or did you have to convince him, or you were always on the same page that, okay, we have this cash cow, it pays good dividend, we can live a good life, but let's build something bigger? Was it always like this, or idea came like a few years ago?
Yeah, I would say it was. We've always been very aligned. Like we're both accountants. We both enjoy the craft of investing. I would say that, and we almost have the same skill set, to be honest. And I think some people say that's a weakness. In most usual business partnerships, you got the Steve Wozniak or the Steve Jobs, the yin and the yang thing. I actually, reflect back. I think we have probably moved into different disciplines of what we are better at outside of accounting and finance, but I think fundamentally we share the same values and we share the same vision, and because of that we just make decisions really quickly. And so I think Rowan leads a fund which is a similar long-term evergreen vehicle, but more in digital type businesses, so more early stage technology, high growth digital businesses, where I'm, what I'm leading is Permanent Owners, which is more of the boring business kind of strategy, but very much the same investment philosophy, which is long-term compounding.
So, and the third co-founder, Simon, you guys met through a cold email, which he sent to you. I was doing a research on 8th of May, 2021, and it's so well structured and seriously one of the best cold emails you can ever receive. So I asked you a favor to prepare. So could you please read this email and we can go from there?
Absolutely, yeah. I'll read it to you word for word because it is a cracker of email. So it says, so g'day, Jason. My name's Simon Plummer and I'm the owner of BT Engineering. I saw your post on LinkedIn and it resonated so significantly with me that I thought I should write in and say hello. It looks as though our paths are quite similar. Accountants turned business owners looking to work with and help aspiring business owners. Without boring you, I was once a pretty average accountant. I left the trade quickly and joined a progressive building company called the Johns Lyng Group, as I thought I might be able to nab some equity. I did, we grew it, and now it is a public company. I then went out to buy a small business, but even though I had a decent capacity, I was only 28 years old. No one took me serious and deal flow was a nightmare. I looked at search funds, but decided to get more creative and launched www.resolve.expert, a website for brokers to list small businesses for sale. The idea was we could go back to those people who wouldn't give us deal flow and get them in front of thousands of investors. Except the thing is we would cherry pick the best businesses before the market got them. Geez, it was a struggle. Launching that startup is not a fun period of my life, but I'll look back at it fondly and nothing should be glorified. But it worked. We listed 100 businesses and saw a few hundred more from all the big four major insolvency firms, mid-tier accountants and business brokers, and we eventually found our one, BT Engineering. I sold my shares in the startup back to my business partner, and dare I say I'll never return to a startup ever again. So BT Engineering manufactures from scratch in Sydney, Australia, the sexiest tools you can imagine, bricklaying tools. It's an incredibly diversified customer base, a cult-like following amongst its customers, recurring revenue via automated systems at all the major tool retailers, makes it for a wonderfully cash-generative business. I ran it for 2 years, launched a digital B2C sales channel in the UK and the US, and watched it grow 30% year on year. I've since employed a young gun to run it and took 12 months off to be with my wife and my first child, Flynn. A bit of itchy feet, so I went to find another business and found the Ausdeck Group in Carroll Park in Brisbane, another fantastically boring cash-generative manufacturing business. A fair bit bigger though, so I found some investment partners in Sydney and we took ownership a month ago. So I just wanted to reach out and say, having been full circle on searching, acquiring, growing and exiting small businesses, launching and exiting a startup, raising capital, securing a large transaction, and frankly, having done it all alone, it would be a pleasure to be an advocate and a useful resource to Arbor in any way that might be beneficial. Here's my LinkedIn if you want to take a look. Cheers. And that was it.
So what happened next?
So yeah, he sent me his details. I reached out, we had coffee, and we were just kept connected. We caught up every probably 3 months ever since to see what we're up to. And early this year, we paths kind of aligned in timing and bandwidth and capital all lined up, and like, hey, let's give this Permanent Owners thing a crack. And yeah, here we are, 12 months later, and we're live.
And what was not the preparation, but what was the action plan? Okay, January 2024, like almost a year ago, you started. Like, how was the process? Can you share till maybe actually raising the capital? How many people you had to talk to? Like, how was the process? Because it's always so interesting. I'm still on the process. It's been 2.5 years. I've been doing it solo. I haven't received such a gold email. I haven't sent it either. But Twitter has brought, and this podcast has brought many very smart people and groups of people who are helping me on this journey. So how was it for you?
Yeah, so I'm a big believer in time boxing things. Like, we basically set a goal. So in November last year, basically almost this time last year, we were like, okay, we're going to give this a real crack. So the first thing we did was a planning session, and it was not your typical like, hey, vision boards and values and stuff like that. We sat in a room and went through a framework. We've never been in business with Simon before, right? And him and us, right? So there's a lot of trust you need to build with a new partner. And so we sat down and looked at, okay, firstly, what do you value in life? Like, what do you want? Picture your perfect ideal workday. What is it? We spoke about what our income needs to be every year. Like, what is our net worth target? We're 36-year-olds. So like, what's a perfect day look like? What does a bad day look like? Or what are the anti-goals that we don't want? Unnecessary travel, dealing with toxic investors, all that sort of stuff. So we basically spent a day with each other to make sure we're aligned, and we were almost perfectly aligned in what we wanted out of life and our career, which is great. So that was the first step. And then the second one was, let's just get busy. So Simon was still working, full-time at his previous gig. I was basically all in on this strategy. And so from January, I just went out and started trying to find a business. And so we were, this is a classic issue with doing any sort of fund or this, PE venture, is that it's chicken and egg, right? Like, I need the capital to do a deal, but also I need to have capital. So I need to do a deal to bring to investors to raise the money, right? So we had some investors who we have invested in our previous funds, but that fund was a venture capital fund, right? This is a very, very different value proposition, right? We're buying existing businesses, not investing in high growth companies. We're investing in very boring cash flow businesses at sharp entry prices. And so we didn't have a lot of track record in that space. Simon obviously did from his operating background, but in terms of us as fund managers or managers of capital, very like a newish strategy. So we spoke to some investors and they're like, oh yeah, I kind of get it. I believe in the thesis. I believe in this silver tsunami thesis, succession planning, but cool. Show me your deals. Like, what deal flow? Well, show me this actually exists in Australia. Right. And so, okay, cool. Take noted. So we went all in on trying to find a deal. Basically, it was like, cool, let's hunt that. And so there's typically two ways that people go about this: is you do your own proprietary search, your origination through cold emails, phone calls, whatever. That's great. And the search funds that I've worked with through my accounting firm, that's probably 90% of the searcher's time is that they spend doing the origination, right? Which is fine. That's cool. But the strike rate is actually, limited. And there's a couple of reasons why. Number one, you've got no track record really, and you don't have the capital at bay. And so whoever, you have to find a seller at the right place, the right time. They've got everything squared away. Their financials are immaculate, and you can just do a deal in a very short, compressed timeline, right? And that's all good. But, in my experience, dealing with sellers who are unprepared and under-advised is just, it takes way too long. Deals die faster. It's not professional, right? So our view was like, let's just go through intermediaries. So let's network with corporate advisors, business brokers, accounting firms. I have a strong network of accountants in Australia because of my profession. So we just went on the intermediaries route. We skipped origination, proprietary research altogether. We're like, no, waste of time. Let's go to active businesses in the market, within our sweet spot. And so we just went through that. So we basically cold emailed, through LinkedIn, all the basically intermediaries in Australia, did a lot of relationships and started to get deal flow. And so we're starting to get IMs, still get two or three IMs a day dropping into our inbox. And you start to educate the market about kind of our criteria of what we're looking for. We found a great business in Britain, in my hometown. That was a proprietary search because we were still looking on the side. That got to LOI stage, but that fell over. But then we came across our cornerstone business, which we closed on, East West Engineering. And that was through one of the mid-tier accounting firms trying to sell it and find a home. And we had to jump through a few rings to hurdles to convince the advisor that, they could back us to get the deal done. So there was a bit of leap of faith from their side as well. But what really was important is that we could sell them a vision as to like why we are not like private equity and why we are not like everyone else and why we will do a good job and, you know, being a custodian of your company, right? This guy, Rowan, he spent literally 50 years of his life building this business. And, you know, the people who were looking to buy from, they're not always optimizing for the best price or the highest price. They're looking for who's going to do a good job to respect my legacy, who's going to look after my customers, who's going to look after my employees. And that's really our philosophy behind permanent owners, is that we can actually respect that because of our capital structure. And so we signed the LOI in June, convinced them that we could find the money, and then we sprinted to raise $25 million to fund the acquisition, which we did within a 4-month period.
How were the conversations with the owner of the business? Because a lot of people say that we don't change many things. We let this business grow as it is. We don't fire anyone. A lot of people say that, but you don't have this track record, so the owner doesn't really have anyone to call to ask like have they done it before? How was it? So what was the conversations and how many times you actually met and talked and shared your vision and idea and gave this owner an opportunity to actually get to know you?
Yeah, that's a really great question. So the secret sauce to our model is Simon. I mentioned Simon before. This is his third time buying a business off a founder from a boomer generation business. So the first one, BT Engineering, he bought. That was a second generation manufacturing business. The second one he bought was a 30-year-old business from a boomer. This business had the same characteristics. So his secret sauce is very good at speaking boomer. It's a very different language. He's just very respectful. We kind of joke internally that Simon's kind of like an old man in a young person's body. He's just very good at, putting on the boomer charm. And so, another rapport is important, right? And I think the rapport is, hey, I'm a business owner just like you. Here is my track record. We have multiple businesses. Here's what we've done. Here's our staff. Here's our team. Here's our investors. If you've got some like here, there's some credible people backing us, and we are credible people, and that helps a lot. I think that's why sometimes it's challenging with search funds, is because if you don't have a track record of operating businesses, let alone owning them already, it's like, oh, cool. Well, that's nice, but what do you know about this company, or how do I know that you're going to be the right person? And so I think having track record certainly helps. And even evidence of that, not necessarily through our funds, but like just through other ventures that we've had. If you don't have that, lean on your investors to support you in those conversations, I think is a good one, because most people will have at least a couple of backers, maybe a board advisor or a mentor who can maybe go tag team in some of those conversations because they'll trust the person with a bit of grey hair. But yeah, that's kind of how we navigated that. And yeah, ultimately it's a sales job, right? Like you got to persuade and convince someone to sell your business to them. No different to you trying to pitch services to any other B2B buyer, right? Like, fundamentally buying a business, someone's got something to sell, you're a buyer, you need to convince them that you're the right person. And whether you're buying businesses or selling accounting services or software, this is a sales job.
And how long it took from the first, so it was broker representative deal, right?
That's correct. Mm-hmm. Yeah.
How long it took from a first conversation between you, Simon, and the owner to closing the deal?
So we met the owner in May this year. We negotiated some stuff. We exchanged a term sheet, over kind of 2 or 3 weeks. And then we got the NBIO, so it gave us exclusivity. And then we closed the deal. Completion occurred the 2nd of December, so 3 weeks ago. So basically start to finish between late May and end of November. So it's 6 months roughly, or whatever it is. So 6 months from start to finish. And
how much competition was there on this particular deal?
It's a really interesting dynamic, right? So when you think about competition, you think about other buyers, and I guess there are many pools of different buyers in the market. And in Australia, I think there's less competition for the strategy that we're implementing. Australia seems to be, we're always 10 years behind America, right, as an example. And so that works in 2 ways. That works favorably in 2 ways. The first one is that we can just follow what other people are doing and just basically copy their model and bring it and localize it, which is a lot of Australian businesses that have been around for decades and centuries have just been rip-offs of American companies. We have our own localized economy. So that's a good thing. You just copy what works for other people. But the second thing is because of less competition, there's probably the multiples are depressed. So we can buy good businesses at still between 3 and 5 times EBITDA that, you know, would ordinarily trade in other markets, in other sector, in other, you know, jurisdictions in America, for example, like, you know, 8 to 10 times, you know, because, and there's just like a more supply, less demand, right? So, in terms of, sorry, what was the initial question? So I'll say that out.
Like how much competition,
Competition. Yeah.
Bidders on the same deal.
Yeah. So in terms of the competition, then, you know, there's kind of really 3 types of competition, right? There's trade buyers, so strategic acquisitions, which you sell to a competitor. There are, you know, listed companies like other serial acquirers, like big listed companies. And then there's kind of like micro private equity or people like us who are like doing like search funds. So really they're your mix of competition, right? And so when it comes to trade buyers, a lot of folks don't like selling to their competitor. Like, you know, for Ron, he spent 40 years of his life trying to fight off their competition. To sell to them feel almost like admitting defeat, right? So a lot of folks don't necessarily want to sell to their competitor. And so that usually rules out a lot. The second one is, where's the bigger version of me? You know, this deal was, you know, there's some term sheets from some large listed companies internationally, some serial acquirers who, you know, wanted to buy it. But again, you know, the idea of being one small portfolio company of a huge conglomerate, they can't promise that they'll insert their own management. They'll just treat your business like a number, right? So there's maybe a little bit of soul that's lost in that. And when it comes to search funds in our experience anyway, typically can't struggle to finance deals above kind of 3 mil of EBITDA. Like 1 to 3 mil of EBITDA seems to be the sweet spot for a lot of search funds in Australia anyway. So it's like that smaller ends where our target size are between 3 and 6 mil, between 3 and 7 mil of EBITDA. That's kind of our target range. So it's a little bit too small for private equity because private equity firms, they really want to see like a 10 mil EBITDA business, you know, because they want to deploy big checks. And so anything below that needs to be like a bolt-on. Or it needs to stand on its own 2 feet, and it's just not worth their time. So we're kind of targeting this really awkward middle zone where there's great businesses in this 3 to 7 mil of EBITDA range, but they don't necessarily have an obvious buyer. And we're a full buyout as well. So this is a full buyout company, and so you've got one founder and there's a management team, but it's still a founder-led business. That scares a lot of private equity away as well, right? Because they need to lean on management and lean on a good operator to hit their IRR or their growth. They prefer to do growth equities type things as opposed to like full buyouts, which is where search funds kind of emerge. So we're kind of a bit of the flavor of the search fund, but slightly bigger up the end of the spectrum. So we found ourselves actually with not much competition, and probably still honestly don't have much competition in the sector of the market that we're targeting and the type of capital that we're bringing to the market as well.
Deals fail all the time. What if this deal haven't gone through? Do you have any others you were discussing, or what would have been the plan B, so-called? Because again, it takes a long time to close a deal.
Failed deals are a killer, not just in costs, but opportunity costs, because you spend, 6 months doing a deal and for it to fall over, it hurts a lot. And I've been in situations where I've been on the buy side and, you get all the way to the end and then some freak of nature happens and someone decides to pull out and a couple $100,000 of costs just been completely sunk. And so, it's always a big risk. We tried to stage gate the process. So, I do my own financial diligence and that's part of, so I'm straight, even the LOI that we issued, I'm already doing pre-diligence on the company. Like I can get a feel for the financials as to whether the quality of earnings stack up and there's no funky stuff in there, which gives us comfort that we won't retrade on the business, because I think often deals fall over because of retrading and not because of, anyone's fault. It's just like, hey, there's new information here, which you didn't furnish in the information memorandum or our discussions. This information is material to structure a purchase price, right? So in the perfect world, what you want to do is address all those kind of hairy things right at the beginning before you even make an offer, so you know what you're walking into and you can price or structure those things into the offer. Because all this whole deals and sales, everything we do is basically expectation management, right? If you can say what you do what you say you're going to do and deliver within the timeframes, that's what matters. And deals fall over typically is because someone's misaligned expectations, or and that's because new information has popped up that someone didn't say, or maybe someone's missed it. I don't know. There's a realm of factors, but only 1 in 3 deals get to completion in my experience on the buy side. So it's actually, the strike rate's quite low. And so what you want to do is try to mitigate a lot of that risk right at the beginning, which we did. So we always do a lot of upfront work, which sucks because that takes time and money. But I guess we're operators, and so we know what to do. So we're not paying advisors to all that sort of stuff. We do it in-house. And so I think that's a bit of an edge where we can kind of de-risk a deal right at the beginning. Execution risk, I would say, reduce the execution risk as much as possible. And if we can't agree on terms at the front, there's no point continuing. But to answer your question, if this deal fell over, we'd be in the hole for $100,000 of probably advisor costs, legals and tax DD. And then, we'd probably still be out there looking for another business, right? And so I think, we'd still be looking. It would hurt egos and hurt, it sucks, like it really sucks, but we'd just keep going, right? Because I think the opportunity is so great. And I think,
You and Rowan know each other for a long time, but you don't know Simon for that long time. Did you have any hard conversations during this time, this period of fundraising, looking for a first deal, or it's been all good?
No, not really, actually. I think so. Simon's very, very ops focused and very opposite, and he's just an exceptional business person, and so it actually worked perfectly because Simon's the ops guy. I was more the financier accountant type prototype. Sorry, and so pitching to investors, they saw that yin and yang dynamic. And never pitched for money before, but it got to a stage where we would fill in each other and a bit of tag team in the pitch, and it worked really, really well. And that just came through just a really good relationship. We didn't practice anything. We just went for it and found our feet pretty quickly, which goes to show the strength of him as an operator, but a good working relationship as well.
Yeah, that's great to hear, because sometimes there is this financial stress and pressure of getting it done, and when it doesn't happen and it takes longer, and you don't have experience working together, it could bring up some tension. But
oh yeah, absolutely. I mean, there's always tension, but it's just cool. Something doesn't go your way, it's cool. What do we do about it? You iterate, or you move on, or you problem solve, and I guess we're both problem solvers in our own way, so that worked out well.
So you're not the typical private equity firm. So how do you structure the holding company and the first deal? And can you share this?
Yeah, sure. So I guess legally we're structured as a company. So I guess equivalent of a C corp in the US, I guess. So what that means is we're not a fund at all. We don't have a manager. We're not externally managed as a fund. But we have funds like Dynamics, and I'll explain how. So we're a company. We have our investors are shareholders. They own ordinary shares and ordinary equity in our company. There is no manager, and so we don't charge management fees. So we get employed a fixed salary that is board approved through an independent board. That salary is our equivalent of a management fee to keep the lights on. And so that's it. As we may raise more capital into the future, we're not incentivized to be honest, but if we decide to, it doesn't mean that we get more money. We don't get more management fees. We just pay the same. So really there's zero incentive for us to raise more equity, which is actually a core difference to a typical fund, right? Most funds, are in, they won't, some won't admit it publicly, but behind closed doors, they're in the game of harvesting funds, AUM, which is fine because they're incentivized to. So they'll get, they'll make some good money off management fees, and they'll do a good return on the asset as well. But they don't need to shoot the lights out. If you return 2 or 3 times return capital in 5 years, they've kind of met their threshold and there you go again type thing. So so that's fine. So that's how we're structured. How we get our upside, we have a carry model, so we get 20% on over an 8% hurdle. But that's only on investor liquidity. So we'll only get paid when our investors get paid. So there's no kind of returns on illiquidity or share price growth or whatever. We only get paid where our investors get paid. That's the philosophy. That's pretty much it. Pretty very vanilla and simple structure. In terms of our carry agreement, we actually have that individually with each investor as opposed to the company. So if one investor decides to sell early or pull out, we just clip their performance fee of that particular investor as opposed to charging the fund. So again, that's a slightly different dynamic to whatever. In terms of our yeah, we're just governed by the constitution and the board, which is formed of us and some NEDs as well, who are also investors. So yeah.
So you said that we've iterated on the model several times over the last 4 months based on market sounding, but we have now landed on a structure that we believe aligns all incentives between LPs and GPs. What did you change?
Yeah, so when we look at a lot of holdco models, I guess the difference with our structure is that if you look traditional, like Liftco, for example, like Liftco started as a couple of guys, you know, they bought a business and then they started to acquire businesses. And as they got bigger, they would raise external money. And so initially they probably owned 100% of the whole damn thing, but then they raised equity and slowly diluted themselves and had shareholders, right? And then, you know, they ended up to where they are today. Ours is a little bit different because, you know, we've got businesses, but it's all tied up in private assets, right? As I said, we're very illiquid. So our view of the world is like, if you've got an illiquid asset that's growing, like why would you liquidate it to then do another illiquid asset? So we were probably, you know, somewhat asset rich, cash poor. And so we didn't have tens of millions of dollars of cash to inject into APO ourselves personally as investors because of that dynamic. And so what we needed to do was, sorry, I lost track. What was the question again?
So you changed the models.
Oh, changed the model. Yeah, sorry. Yeah, sorry. So as I said before, so most people start with equity where we didn't basically have, we would invest cash, but, you know, we could only invest, you know, a couple of $1 million and 25 mil, you would own a small part of the cap table. And so what we thought, we started getting a lot of the holdcos internationally, and what we decided was actually, if you want to truly align incentives between GPs and LPs, there would be no carry, there would be no fees. It would just be, you have equity, I have equity, and we're paid to do a job, and that's it, right? And so what we initially structured is that we get 15%. The version 1 of our capital pitch was we would get 15% of sweat equity for putting the deal together, getting it all done. And then we would have, through performance, the ability to earn an additional 15% of equity through hitting some IRR calcs or multiple invested capital, whatever, right, over a time horizon. So basically, as a manager or as a lead, we could earn up to 30% of equity, which would be ordinary equity, by the way. Our co-investors still get pref, so get liquidation preference and stuff like that. But basically, it meant that we would be like even keel with our investors, and we would be basically like them in terms of equity. That didn't go well with the investors that we pitched. And the main reason why is the trade is asymmetric from their perspective. So what they're saying is, hey, cool, I'm going to give you $1 million, but you're going to give yourself 15% equity for what? What have you done? And so there's already a discount to the NAV from day zero. Even though we bought well, even though, you know, we've structured the deal really nicely, like, yeah, it doesn't matter. But just because you've structured, you bought a good asset cheaper than what you might be able to get elsewhere, that's not your upside. The upside should be only when you actually realize the return, right? And so buying well should just be your job, not equity, right? So
good feedback,
like, okay,
feedback actually.
Very good feedback. It was a very, very good feedback. And probably the most thoughtful. And it was my old boss who told me this because I pitched an investment and he said, no, this is bullshit. Like, it was very, very candid because he came from, he's a public markets guy. And he was like, wait, so you're saying that you issue yourself equity? For what? What? You haven't bought it? You haven't earned it? Like, what do you mean? He's like, oh, well, we're doing this. We're putting all the capital together. Yeah. But like, that's not worth anything. Like, you're just doing your job. And, you know, if you want equity, you should buy in like everyone else. I'm like, okay, no, it's a very, very good point. So I did agree with that. And we pivoted. So we pivoted 4 times in our compensation model to land where we landed today, which is what I described earlier, which is basically a 0 and 20. But
what else did you try? What else did you do?
It was variations of that. So we started with the equity thing, and then we're like, oh, okay, well, what if we just what if we get the equity? So what if we start with equity and have like a reverse tranching? So we start with 30%, but if we don't hit these targets, we lose the equity. So we can get diluted to basically 0 if we don't do any well. But then the feedback from that was like, yeah, but if you basically fuck it up in the first 3 years, you get 0 equity, who's going to run the thing? Like, you got 0 incentive to run it and you're left with a portfolio of shitty businesses and I'm just stuck carrying the bag. Like, doesn't work for anyone. So like, okay, that's good feedback. So it's, that was the second one. I think I can't remember the third one, but yeah, we were at multiple times based on market sounding. And that's probably a lesson in that, right? Because we were very fixed. We had a very fixed view of what this should look like and why. I wrote memos, it was in my IMs about why this is the best way to align incentives. And just because philosophically we think it's the best way doesn't mean that the market will respond well to that, right? You know, investors don't give a shit about you. They don't care about themselves and what returns they can get, right? And so you need to meet the market with what is acceptable, what's commercial practice. Even the 20%, like we didn't want to do 20%. Like, why is it 20%? Why not 25? Like search funds are 25. Like, why not 25 or 30%? Brent Bishaw's permanent equity is 30%. Like, why 20? And everyone's like, no, 20% is just how it's done. So just make it 20. Okay, all right. We just have no choice. We'll just do it like everyone else. So, yeah.
Did you go back to the same investors, to the same boss, and you had like 4 or 5 meetings with him, and every time he was like, man, just he was probably interested in the idea. He believes in this, the traditional businesses, your track record, other founders' track record, that you're capable of actually doing it very well, but the structure itself he didn't like, but you just kept going back, right?
Yeah, exactly. You just go back, you're like, okay, cool. Like 24 hours later, here's the array version. What do you think? You're like, oh yeah, I like it, but like they start to critique it, and then by that stage they're bought in, right? They're like, oh, cool, like we're iterating. It's very much like a startup, you know. Like you version 1 of a beta product. Like yeah, kind of works, doesn't like change these things, and you eventually iterate to a working model, and that's your product. So that's kind of exactly the same approach. I would say the other difference, the other evolution we did was a dividend yield, right? So we are philosophical. Again, this is where you can get too romantic about permanent capital and patient capital, is that, you know, if you really want to subscribe into the permanent capital model, or, you know, the Berkshire, you know, Warren Buffett world, is like dividends are the enemy almost. It's like if you're distributing capital back to investors, it's almost like you've lost. You're saying that I can't invest at my hurdle rate. So like take the money back. And so we were very much like bought into that narrative of like, yeah, we're paying no dividends. This is a compounding vehicle. Like if we can buy businesses at 3 to 5 times and then, you know, 20 to 30% ROIC every year, like you'd be crazy not to continue to reinvest, right? And that's pretty much our philosophy. But then you think about it from an investor's perspective, and because we are a private company, right? We're not public. Like the difference with Berkshire and something like this is that number one, it's Warren Buffett, is a very long track record, but mechanically, they're a public company, right? So if investors want liquidity, they just sell their shares, and like they got their liquidity. Where in a private company, very difficult to sell your shares, or less easy, I would say. And so picture this, right? You're an investor. You got some money, and then couple of 36-year-old kids come up to you and say, "Hey, we're doing this doing this boring business things, patient capital, whatever. So we want $1 million of your money, and you may never ever see it again." How would you feel about that? So, and I was like, I don't know you, number one. Number two, yeah, limited track record. Number three, wait, so like, how do I, like, what do you mean? So you're saying I'll give it to you and like, I may not see my money? I'm like, yeah, because you'll be compounding with us. But yeah, cool. But like, eventually I need a return, right? Like everything has an end, right? And so the term permanent actually doesn't work well when you're trying to raise money, because it's very scary, right? So we call it long-term. So we pivoted our terminology to long-term, which it is. It's long-term is greater than 10 years. And so it legitimately is. And I think the permanent nature of it is more a pitch to the vendors or the sellers who are looking to sell to us, is like, hey, we're a permanent home for what you're doing. But the concept of illiquidity is a really challenging thing, right? Because you do want to reinvest in rather on compound, and you want to stay private because, I don't know, we may evolve later, but like, I don't want to become a public company. It's such a pain in the bum with all the compliance and disclosures, and you end up, spending all your time doing governance as opposed to actually doing the business and investing. And so we want to stay private, but investors also need comfort around liquidity. And so we introduced the dividend yield, and it's 8% from year 3, so it's 8% of the primary capital raised. And that just matches our hurdle rate, so it's 8% yield. And it actually changed the game a lot from our investor appetite, because number one, it's a pretty good, it's a good yield product. Like, it basically matches what you could otherwise get in the S&P 500 to an index. But secondly, so it's more, the benefit was psychological for them. It's like, cool, at least I know that I'm getting some sort of cash back throughout the journey. And yeah, I think that you guys could probably do well in terms of capital growth, but like, at least if it doesn't shoot the lights out, at least I've been paid along the way. And so psychologically, it just helps to break that barrier. And also, Australian investors love yield, man. Like, the Australian investor appetite, love property. We have some of the highest residential property prices in the world per capita. Just property is the asset class here. There's not a lot of interest in private equity or small businesses. And so we're bringing a new type of product to the market, and we've had to educate them as to why it's good. And, boomers, they want your yield, man. Like, you got to pay yield somehow. So, yeah, we're honoring that.
Maybe you answered this question, but how are they able to exit in the future or earlier? Let's say something happens on their side and they want to get out on year 4 or 5. How you can provide that?
It's a really good question. This is the investors had 2 issues with the model. Is like, number one, like, you're a serial acquirer, great. How are you going to operate 10 businesses at scale? Like, yeah, cool. Like that can be solved. Like, there are many businesses doing that. So we have a playbook around that. But the biggest question is like liquidity. Like, the yield's good. Like, sure, I get some dividends, but like, what if I want to divest some assets? What happens if I get divorced? Like, what happens where all that scenario? So we are a big believer in developing a secondary market, and that's my job, is to build a secondary market. So we have 41 investors in our cap table, and there's a very, very broad mix of a profile of those investors. Some are some large family offices, some ex-PE, some PE, private equity head honchos. We've got some accountants, we've got some lawyers. Our chairman is Glenn Richards. He's the founder of a company called Green Cross Vets, which was basically Australia's largest vet clinic roll-up. $2 billion of turnover does today, but he built that and is chair of our board, has very lot of experience. And so we've got a very good dynamic mix of investors and business owners. And so we think that there is a lot of liquidity within the investor group. So all the existing investors have preemptive rights. So if someone wants to sell, they go to me as a manager and say, hey, okay, Joe Bloggs wants to sell 5 shares. I'll go to the market and say, hey guys, 5 shares are for sale. There's a share price that's dictated by an external valuer. So from year 5, there's no liquidity in the secondary market to give us 5 years to, grow capital value. From year 5, we'll appoint an independent valuer who will value the assets and so the share price. That informs the share price. It doesn't dictate the share price. That's it. It's the price versus value thing, right? Because accountants are typically conservative with their valuations. And so we basically, here's let's say the share price is $5. It's grown from $1 to $5. That's the share price. It comes to supply and demand. If there's more buyers than sellers, like, there'll be a bidding contest for that $5 could go higher, could go lower, right? And so then we'll help facilitate that transaction, and then we take our carry if we're in carry territory, and then we make it happen. That's it, right? If we do a good job, there will be more buyers than sellers, and so that's our thesis behind that. If we can't provide liquidity within the existing investor group, we'll go out to market, and hopefully, again, if I do my job well through investor relations, communication, we'll have a long list of investors that missed out in the primary round but are dying to get in, and they want to be part of the club. And the entry price is some shares to buy shares into the club. So building, what my goal is as a manager is to build a cult. We're really building a cult of investors. The investors we have are mainly a lot of rock stars, and so we try and build a profile of not just quality shareholders, but the community of shareholders as well, and be able to rub shoulders with some pretty impressive business people, and try to do all that sort of stuff to make it a bit of a cult ticket.
How many investors did you talk to, and how many were eventually willing to fund? Like 41 investors, but how did it work? Like, one said yes and made intros to other ones, or how was because 41, it's a lot of people, a lot of meetings, a lot of how did it happen?
Yeah, so I reckon we had over 250 investor conversations, so that through Zoom calls, through pitch, like in-person pitches. Actually, how we drove that. We have some of a network, but it wasn't massive. But I've been posting on LinkedIn from my own content marketing for 10 years now. And so I previously have been sharing content, mainly B2B, kind of finance, accounting, educational sort of stuff. But that was really to get business for my accounting firm back in the day. When I was starting my accounting firm, I needed to get sales, and content marketing was the thing. It still probably is the thing. But then, what was untested is whether we could use that audience to raise capital. And actually, a lot of the investors who have backed us have come through social media and have followed the journey since when I started my own accounting practice 10 years ago. So they've kind of seen the progression of the story and bought into that vision and built trust at scale, which I did not expect, to be honest. And so that helped that helped a lot. which is wonderful. We've got very lucky there. But yeah, so over 250 conversations. The process was we basically sent EOS. If you're interested, here's our IM, here's our deck. We were basically building in public, so we're like sharing updates every week because we're trying to do the deal at the same time. We're iterating on our investment capital pitch at the same time. So we're sending weekly, fortnightly updates of like how we're progressing with things, updates. Here's what's changed, here's what's new. And so people were trying to get slowly being bought into the vision through an email, weekly updates. And then, push came to shove, we needed to get the money. And so we put an EOI out, like expression of interest of like, hey, if you know us, here's a draft IM. How much are you going to put down? And we made people commit to a non-binding offer of like investor capital. And we raised what we needed to get past the next hurdle with the vendor to buy their business. Like we had to make sure that we had enough capital to commit to proceed with the investment, which we did, thankfully. And we had a 100% conversion rate from the EOI to closing capital. So like that goes to show like the conviction of the investors that we had and the conviction that we had in them as well. So we set some fairly high hurdles for the investors to make sure they're not wasting our time and vice versa, which... Again, we got very lucky in the process, I would say. It was like, yeah.
I disagree with the luck part because sharing your journey for years and doing these weekly updates, it requires a lot of work, and I would just say it paid off as it should be, in my opinion.
Yeah, I think that, this whole concept of luck is really interesting because, I've been unlucky in my career and I've witnessed, I've first-hand experienced unluckiness, and I've been fortunate to experience luck. And I think, the idea of luck is, I think the best definition of luck is like when preparation meets opportunity, right? And, for this to come off, there's so many stars to align. Like, you think about raising capital generally, like you need to find people who trust you, number one, and put in front of them a product that they like and are comfortable in. And then you have to time their liquidity, right? Because not all investors keep $100 million of cash in the balance sheet, right? It's all tied up in stuff, right? So you need to time those things. And we had some great investors who I'd love to have on, but they're like, Jason, can you just wait till just like January next year? Just wait 3 months because I'll be able to write a $3 million check if you just wait 3 months because I've got something coming to market and it'll be sold by then. It's like, no, we can't wait because we need the money to pay the vendor. Like this is, so like, capital raising is extremely difficult because you need so many things to line up perfectly in your favor. And if they don't, one small thing can kill it, right? If we couldn't raise from a lead or, we couldn't get the chairman involved, like that like one thing can just collapse the dominoes. And a lot of luck is involved, right? And yes, you have to be prepared. And yes, we had some assets that we could leverage and all that sort of stuff. But, it doesn't take much for things not to go in your favor. And so I really truly believe we have been lucky in the process.
So I asked about the investors' feedback, and second thing you mentioned was how they can exit and how they can get paid pretty much. But the first thing you just went over it slowly. The question they asked about the playbook of how do you manage, how do you run a portfolio of 5 or 10 or more businesses? And you said you have a playbook for that. I think you probably answered that so well that you actually know what you're doing. So otherwise you wouldn't move to problem number 2, which is how do we get paid? So can you share the playbook or some of the details on your views on how to actually do that?
Yeah, I think, for sure. So over time, we see ourselves, and again, we might be being romantic about this, but over time, we see ourselves being more of a platform, combining people, capital, and businesses, right? And so that's fundamentally what private equity is, right? That's what we do. So you need obviously good businesses that are good investable assets, like you need that. And our thesis is that there'll be a shit ton coming to market because they all need succession planning. And so that's our piece around that. The capital side, if you've got patient alliance capital, like that should sort itself out. The people problem is the tricky part. And so, Simon's, this is his 3rd time running, buying, professionalizing, and then exiting as management a family-owned business within this sector of the industrials products, which is our focus. And so we've got track record of doing it in a systematic way. They'll get to a stage, we're very slow going, like we'll buy this business today, we won't buy the next one for probably at least 18 months to 2 years. And I think the businesses that we will buy would be more bolt-ons to this as the platform. So we'd be buying stuff within our sphere of competence, and we can leverage the team and the database and stuff that we have built as an asset. Over time, though, we're going to have more deal flow than we have operators. Like that's just going to happen, particularly because we're a buyout firm, and so we need operators. And so our thesis is that we need to basically build a recruitment engine within the holdco to essentially find the best operators to steward these companies, incentivize them in the right way. So I would say, honestly, no different to any other business that needs to find a CEO. It's the same process. It's not easy by any things, but like the idea of having it all centralized in a holdco model is that you can share the resources. Not necessarily day-to-day operations, because we are we will be the decentralized operation. Headco would be very handful of people, and everything's decentralized to the CEOs at the portfolio company level. But the community element of the CEOs, building a peer network, again, copying and emulating what some amazing investing models out there in the market already, basically just emulating what they've done over time. And we're in no rush to do things, right? So we can take our time and be patient around that. But there's no secret sauce. It's just finding the right people and incentivizing them well.
Going back to this investor discussion we had, the pitch you said, was it deal by deal, or you said you're going to raise 100, 200 million? Because why I'm asking this, like you got this deal done, but what about the next one? Do you have like a mandate to deploy like 100 million over the next 3 years, or how does it work? Because the investors need to know, probably, because I guess in order to track their capital. So when they get a call from Jason that, okay, we have another one, very good, attractive deal for, 3 times earnings, so we need capital. So how do you set it up?
Yeah, it really so. So I'm a very large admirer of Mark Leonard, Constellation Software, where they basically raised, I think they reported 25 mil, but I think it's more than that. They've raised $40 million of equity back in the 90s, and they've essentially compounded that. They've raised no equity since, not diluted any shareholders. They've basically funded all the growth through free cash flow and debt. That's our model. We're basically, that's the idea. We only raise the money that we raise, and the idea is that all future acquisitions will be done through cash flow and debt. We basically equity funded this first acquisition with no debt. We took a little bit of debt, but not a material amount. For that purpose, is that next business will use debt, and so we'll just basically, and because we can be patient, like it's just a long-term vehicle, the nature of compounding, we think that we can grow our EBITDA from, call it 7 mil today to the goal is to grow it to 45 mil in 10 years EBITDA, just through compounding through acquisition, organic and inorganic growth, but mainly inorganic, but not raising any more equity throughout that process.
Do you still have like 5-10 minutes?
Yeah.
Few more questions.
Yeah, far away.
Reading your deck, I know you have a very strong opinion on that. I said I was reading your deck, and did you ever consider looking for smaller businesses than 3 million EBITDA, and why? And what are your thoughts?
Yeah, so the biggest risk when doing a full buyout, we're a buyout company, right? So like, assuming there's no strong management, like we need to take over the management of the business. The biggest issue is key person risk. Like that is the number one risk of buying any small business. And our philosophy, and this is through learned experience and through working with clients and through the experience, is that search funds play in the 1 to 3 mil is because the CEO will step in as the searcher will step in as the CEO in transition. And the thing, but our model is like, yeah, we still need someone to run it, but like we still want a margin of safety, right? And so our view of the world is that in a small business, you can kind of still run a probably up to 2 and a bit mil EBITDA business. You can still run that with a solo operator, like a sole key person. I've seen some great services businesses who are still very much reliant. They're doing 2 mil of earnings, but still very much dependent on the key owner. So but when you get to kind of 3 above, it gets a bit too big. A business, you have too many staff, operations get a bit more complex. And so naturally, the business needs to have a second line of management because of the size, the complexity of the business, right? So the business evolves into something a bit bigger. And so our observation is that the 3 mil is kind of where 3 mil above is kind of where you need a bit more robust management team. And that's valuable, right? You want to have a good second line management, because if shit hits the fan, you don't want everything reliant on the sole person or the key person risk, right? So it almost, let's say eliminates it, but reducing significantly the key person risk the bigger you go, right, as a business. And that's why bigger businesses trade at high multiples, right? Because it's, there's less risk, in theory, less risk of the business. And so that's our view of the world. And it's not always true in all circumstances, but that's true. Also driving that philosophy is that we don't really do services businesses. I spoke about my view on services businesses as assets. We are focused on product-based businesses. So products that are selling OEM type products with a brand, and customers buy the brand, not the owner, right? And so it's less dependent on the key personal relationships of the vendor. It's more about, I'm buying the product because of the quality, the safety, the reliability, all that sort of stuff. And so, yeah, that drives that thesis. Now, in other markets, maybe the US, anything above, maybe that 3 to 8 mil of EBITDA, like that's when multiples get really maybe too expensive, like too high, but you might be looking at 5, 7, 8 or whatever. And that's where, because of competition in Australia, you can still buy, business up to 8 mil of EBITDA for like between 3 and 5 times EBITDA. Like it's just a different market dynamic here. And in fact, there's less buyers because of those structural reasons I mentioned before. It's just less competition, that weird, awkward deal zone. And so, yeah, it's a safe place for us to be hunting. We'll buy smaller businesses, but that would need to be bolt-ons to the existing business. We wouldn't buy a separate platform at less than 3 mil. No way.
So you've owned the business, the one you bought for very short.
3 weeks.
Yeah, 3 weeks. You started a year ago with a big goal of doing this, and we can say you succeeded because you got so many things done. You raised the capital. You bought the business. Being 100% honest, totally honest, how does it feel? I mean, this is a massive success because now the world is your oyster, pretty much, as they say, because you have the track record now. You've gone through all the craziness, and you now bought the first business, and whichever will be the next one, they can always call to this owner. I think his name was Rowan. Like, how was this experience with the guys? So, how does it feel like owning a business?
I'll be glad when I'll be enjoying my Christmas break next week, to be honest. I'm a little bit burnt out. It feels good. Like it hasn't been an easy last 3 years, professionally, and just, a lot of our, I won't go into that, but it's been pretty challenging economic climate, I think globally. So to get something done, we're proud, but unfortunately I'm one of those people, probably most of your audience is like, hey, cool, got something done, great, what's next? Yeah. So I will step back and reflect, and we're really happy with the outcome. But it's like, okay, cool, now I'm a custodian of businesses and other people's money, right? So that is that's an evolving journey, and I have fiduciary responsibility to make sure I'm a steward of people's capital, and I do a good job with that, right? So there's new challenges that evolve, but that's a new set of skills and growth that I'll embark on personally. So.
Okay, so I think I want to do a part 2 with you, like everything post acquisition in 6 months, in 12 months. So I think would be a good idea to stop here because you're 3 weeks in. So I would love to hear the stories. What's gonna happen now and how it all went. So. Maybe last question, what do you consume and what are you planning to consume, and who are you going to talk to get better at growing this business? Because I think you just said the goal is to do some bolt-on acquisitions and not only rely on organic growth. So yeah, what do you consume, what do you learn, and how you're planning to prepare yourself in order to grow this business to maybe double it within the 2, 3, 5 years?
Yeah, so I think first off, we are blessed to have an exceptional board. A board at the holdco level. I mentioned Glenn's. He's the guy of roll-ups in Australia. So very privileged to have him backing us and coaching us and mentoring us. A lot of the investors are also business operators as well. Entrepreneurs have had exits, and so there's a bit of grey hair in the group, and so. a lot of them have expressed interest to be part of the advisory board of our portfolio companies and put their hand up and advise. And so we'll be listening to, the cherry pick the people with the right skills and the right time commitment to within our investor group to support us. Obviously, they're incentivized for it to do well as well. Outside of that, in terms of content, as I said before, you do an incredible job of creating content and writing stories and interviewing folks that have done this path multiple times and successfully. So continue to be a voyeur and consumer of content of folks following a similar journey. That's kind of it. And obviously, as we learn more about this industry and materials handling industry, learning about talking to potential sellers of businesses and learn more about the industry. That's just through talking to people.
Okay, so quick fire questions. How old are you?
I'm 36 years old.
Favorite book?
Favorite book. I don't have I would say I don't have a favorite, but the most memorable book is Kitchen Confidential by Anthony Bourdain.
What's the best investment advice you've ever got?
I will go a bit of a tangent here on buying SMEs. I think that there's a false economy on Twitter, particularly about this idea of buying these small businesses, no money down, or leveraging up with SBA loans and stuff. And I see these posts, and I have a strong view about debt, and I've come from an experience where too much debt hasn't been a good thing. And I think that, just because you can take 80 or 90% leverage on a small business doesn't mean you should. I think it's actually irresponsible in many ways. And I think that some people romanticize the idea of SME ownership and, running multiple businesses and stuff like that, where I just think it's just bullshit. And so I think start with one and then build a base and learn and evolve from there. Don't try to go out the market and try to buy or roll up 5 businesses if you can't run one by yourself. So I think that's probably my little off-piece tangent there on that one.
There's a lot of people on this journey, so thanks a lot for being so transparent. Where can people find you if they maybe have additional questions?
Yeah, well, I'm an open book, honestly. So if I'm on LinkedIn, that's in Australia, Twitter's not really a thing. We follow it, but we're not really active. So yeah, LinkedIn, you can just search me, Jason Andrew. I'm fairly active in there. Send me a DM or an email. Happy to help.
Awesome. Again, Jason, looking forward to part 2. Best of luck with the first deal. And again, thanks a lot for doing this. Talk to you soon.
Thanks, man. I really appreciate it. Thanks, man.